Chapter 16, Part 2, Permanent Differences and Changes in Future Tax Rates. We'll go through some examples. Now, permanent differences are caused by items that are adjustments for book income but never for tax purposes. Examples would be fines, proceeds from key employee insurance, i.e. usually insurance on the officers of the company, and tax-exempt income, or are deducted for taxable income but not for book income, such as dividends from investments in other company stock. Permanent differences only appear in the period in which they occur. There are no deferred tax consequences. Now let's take a look at an example that has both temporary and permanent differences. Wise Company began operations in 2021. They had pre-tax financial income for 2021 of $100,000. They had a tax rate of 25%. The difference between the income statement and tax return are listed below. Now first, one of the differences was warranty expense accrued for financial reporting purposes amounts to $7,000. Now remember, warranty expense is an estimate under GAAP, but for tax purposes you can only write off the actuals, which are only $2,000. So in that case, we're going to have to add that back into taxable income. Now, gross profit on construction contracts using percentage of completion method per book amounted to $92,000, but gross profit on construction contracts for tax purposes was only $67,000, which means that you don't have to show all of that income. You're going to have to back it out. So you're going to back that out for taxable income. Now, depreciation of property, plant, and equipment was $60,000, but for tax purposes it was $80,000. So we're going to get to deduct another $20,000 on our taxable income. Now, a fine paid for violation of a pollution law was deducted in computing pre-tax financial income. You cannot write those off on your taxes. So what we're going to have to do is add that back in for both tax and book. Interest revenue recognized on an investment in tax-exempt municipal bonds amounts to $1,500. That's an adjustment for both tax and book, so that you wouldn't have expense or payable on that amount. So we're going to assume that the first is a short term in nature and 2 and 3 are long term in nature. Now determine book income and tax income. We start with our $100,000. We're going to adjust for our two non-deductible, non-taxable fines and interest revenue. So that tells you what our income tax expense is. Now we're going to adjust our taxable income. So what we're going to do is add back in those expenses we backed out based on our estimates. We're also going to have to minus the revenue. And we're going to have to also allows us to take more depreciation. We're going to minus that from taxable income. And on the warranty, we actually add that back in because we can't deduct it for tax purposes until they actually occur. So we end up with taxable income of $62,000, which means that our income taxes payable is $15,500. Now, our warranty costs are a deferred asset because the benefit in the future when actual warranty expenses are incurred and can be deducted for taxes. Now, our construction process and depreciation are going to be a liability because in the future we're going to have to pay taxes on the profit and we'll have less depreciation we can write off because we've already taken it for tax purposes. Now let's look at our journal entry. So we're going to have income tax payable, deferred tax asset, deferred tax liability, and our plug is income tax expense, but we've already calculated that. Now these two are going to be netted together for a deferred tax liability. Now we'll look at what our income statement looks like. It would show before tax, it would show the current and deferred, and that would show our net income book purposes. Okay, so we always are going to net those two together. So what about changes in the tax rate? Well, if deferred tax liability or asset equals temporary differences times the currently enacted tax rate effective in the year the temporary difference reverses. So, calculations are not based on anticipated legislation that would alter the company's tax rate. When enacted tax rates differ, existing tax laws may call for enacted tax rates to be different in future years in which a temporary difference is expected to reverse. Specific tax rates of each future year are multiplied by the amounts reversing in each of those years. So now let's take a look at a problem. All right, here we have this one. We had a deferred tax liability of $5 million related to a temporary difference of $20 million. The tax rate's 25%. The temporary difference is expected to reverse in 2022. A new tax law was enacted that will decrease the rate to 15% beginning in 2022. The taxable income in 2021 is $30 million and net income before tax was $40 million. What's our journal entry? Well, income tax payable is going to be $30 million times 25%. Our deferred tax liability is going to be the difference in the percentage. And income tax payable is going to be a plug. Now, what's the effect on retained earnings? None. When a company revises a previous estimate, prior financial statements are never revised. Remember, when we have a change in estimate, no revision. But you may want a disclosure note. What if it had been a deferred tax asset? Well, it would look like this. And that ends this presentation.